Larry, that's all great information. And so it kind of brings us to the point, now that we understand the value, importance, and really necessity to at least discuss home wealth as part of a successful retirement plan for longevity, to make sure you have enough money that you don't outlive it. Because we talk to folks all the time, it's amazing, in their 90s.
Well, if you're in your mid-60s, you have a high probability that you're going to live into your mid-90s.
And I know growing up,
that could be 30 years.
Absolutely. And I know growing up, we were always told to plan for maybe 15 years of retirement. Yeah. But that was back
15.
Too many years ago.
Yeah, retirement could be 30 to 40 years easily, and it's going to keep expanding.
So even if someone like myself, a boomer, had done what they were supposed to do, I would likely only have enough there for maybe 15 to 20 years, and I could expect 30 or 40. And I think that there's a lot of folks out there that are in that same boat, and they're wondering what to do.
Well, and the big risk is in those last years of your life, okay? That's when the health issues come, that's when the long-term care requirements come. And so your costs of living can just escalate in those final years. So you have to have resources and you have to have a plan that's going to cover that risk.
So let's talk about how the reverse mortgage can benefit people in retirement, entering into retirement and planning, and how it can be used to successfully accomplish the longevity of how long we might live in retirement. I think one of the most common conceptions of a reverse mortgage is that it helps you eliminate your monthly payment. How would not having to make a payment contribute to the longevity of your retirement account?
Well, it's going to reduce your cash flow needs during retirement, period. So if I reduce my need for living expenses by whatever that mortgage was, whether it's $1,000 or $2,000, that's money that stays in my investments, helps me live longer.
So just to kind of quantify that a little bit, if somebody's got, let's say, $1,000 a month on a mortgage payment, which is really kind of low these days, but just to use $1,000 a month, I know that there's something called prudent disbursement numbers and how much you can take of percentage-wise.
Right.
To get $1,000, what does somebody need in their retirement account if they're dispersing it wisely?
Well, you need about on $1,000 a month, that's $12,000 a year, and you use a multiple of 5 to estimate roughly how much money you need. So that could be $60,000 to support that and to support that payment.
Okay, so
if I don't have to make it,
yeah,
that reduces my need for investment by that amount.
Okay, so that's quite a lot of money that people have.
It's a lot of money.
So it's like giving that much a raise in their retirement account.
Nice raise, yes.
Yeah. So that's one thing. So that in itself would help you eliminate reducing your retirement accounts so that they have more time to grow. Because isn't that a big factor?
Correct.
The longer you have your money, the more it can grow, and it does better for you. If you use it all at the beginning, you're not doing so well.
Absolutely.
So if you can postpone that, and there's another piece too. If you don't have a mortgage payment, $1,000, $1,500, $2,000 a month, how much would that help being able to delay either withdrawing from your retirement accounts or even something like Social Security? Because is there a benefit to delay some of your Social Security?
Oh, absolutely. If you start taking your Social Security at age 62 versus taking it at the latest age you can take it, which is age 70, that's like a 72% difference or something like that, okay? If you start taking it at 65 versus 70, it's a 32% difference.
Yeah.
Okay. So yeah, it can be huge. And the break even on the Social Security, if you take it early versus later, is from an income standpoint is about age 80. But if you're living into your 90s or your 100,
it pays to take it later.
Yeah. Oh yeah.
Yeah.
And it also pays, especially if you're married, it also pays from a spousal perspective. So it gets very complicated when you're talking about Social Security strategies, but yes.
And one of the features of the reverse mortgage is that if you have enough equity in your home to either pay off your mortgage and have some extra money, or even if you don't have a mortgage, you can do a reverse mortgage to access the wealth that's in your home. And you can receive those funds as monthly income. So what do you think of the strategy of maybe using a reverse mortgage to have income for 2 or 3 years to delay Social Security?
Oh, it can be a phenomenal economic transaction. It can work very, very well.
And I'm in this age, so I'm looking at the numbers for myself, and just taking an example, somebody that is due $1,000 a month at 66 is going to get about $750 at 62, but if they wait till they're 70, they'll get about $1,300 plus. So those are significant numbers.
Yes, and if they have a spouse, it can affect the spousal benefit too. So there's a big multiplier off of that.
There is. So it can benefit just by waiting to delay your monthly income on retirement.
And most people make the mistake still of taking Social Security very early. A lot of people take it at 62. Most people I run into do not understand the issue at all.
And they also feel like they have to make their mortgage payment.
Yep.
And they're taking that.
A lot of people think, hey, I worked all my life. I want to get that benefit. I want to get it now. It might go away. They think that way. So Social Security planning is a real critical thing that people need to do.
And this is a good tool to help that.
Absolutely.
Okay, there's some other features about the reverse mortgage. And one of the folks that we both have great affection for, who think that they are one of the premier financial advisors in longevity risk in the country, Don Graves.
Yes.
He calls it the 8th wonder of the financial world. The home equity, the equity line of credit that's available through the reverse mortgage. So we're going to talk a little bit about the line of credit.
Okay.
The line of credit for a reverse mortgage is the excess money that you're eligible for after you pay off your current mortgage. If you have no mortgage, then all of the equity that you have, or all of the wealth that's available to you in your home, it can be in a line of credit. And the line of credit is guaranteed by the federal government for 2 things. One, it's guaranteed to always be there. It doesn't matter if your house is worth 0, the line of credit is guaranteed to be there. And here's the other factor. It's guaranteed to grow. It's guaranteed every year to increase how much of the additional equity in your home you can access. So there's an immediate growth factor. And so if somebody has a line of credit, and I'm going to jump over to you in just a second, and they're at age 62, and they've got a line of credit based on the age that they are and the value of their home of a couple of $100,000, that's compounding. As a financial planner looking to avert the risk and extend longevity, what are some ways you might look at that line of credit and talking to your clients on how they could most benefit using it?
Well, for me as an advisor, I think one of the biggest areas is managing the concept of what we call sequence of returns. Okay.
That's a fancy term. What does it mean?
Okay, sequence of returns is that when you look at the returns of a portfolio over time, you get good returns sometimes, and you get bad returns sometimes.
So my understanding, you're talking about the market, stock market,
we're talking
bond
about
market.
We're talking security markets. We're talking equities. We're talking fixed income. We're talking, everything that's traded in the public market.
So things go up and things go down.
Things up and go down.
And it's guaranteed that sometimes they'll go down.
And the problem is, as a person in retirement, you need money every month. Okay, I need money every month. So I might need money during a time when the markets are down, okay? And if I take the money out during a down period in the market, I never recover those dollars. So the market always goes up and down, but it always on an upward plane, but it can go down a long ways. In 2008, 2007, it went down 50%, okay?
And if you needed money then?
If you needed money then, you have to take some money out of that and you never get it back.
So you lock in your losses.
Right. So your credit line allows you to supplement that and protect you against that risk. So instead of taking the money out of your investment portfolio in a bad time, you draw on your line of credit, okay? And then during a good time, you pull that money back and you recover it, okay?
Yeah.
So sequence of returns is a huge risk.
So if I can say that back to you, sequence of returns means that you don't use money after a down year and you need another source of money to pull from.
Correct.
And that if you pull from the other source and let your other accounts recover,
right,
you're going to end up with more money in the end.
Correct.
And isn't that the goal of the game? To end up with more money in the end, no matter where the money comes from?
Yeah, and when the market's up, you take that money out, repay the line of credit, and you're back at it.
Yeah, I think we were both looking before we sat down here at these graphs. And there was a graph and a scenario that we were looking at where somebody with a $500,000 retirement fund didn't have another source of funds to draw on. And after, there were just 5 down years that we were looking at. And those 5 down years, they ran out of money at the end of the 23rd year. Correct. So somebody at 62, you're talking about them running out of money at 87. And then we looked at another scenario where in those 5 down years, they pulled money from their reverse mortgage line of credit. And how much, do you remember how much they had at the end?
$1 million at the end.
They had $1 million, instead of running out at 87, they had $1 million left at the age of 99. That's powerful.
I think it's the most important benefit of a reverse mortgage.
Is the line of credit.
Yeah, but like I said, advisors don't teach it, don't look at it enough because they got all these other things they're playing around with, or working on. But yeah, I think this is the biggie. This is the biggie.
Yeah, and so one of the things that people are really concerned about is their health care, long-term care, assisted living, because most people have not planned for that. And
well, by the time a lot of people think about it, they're getting older, okay, in their 60s, for example, and they may have medical problems. So if you have medical problems, you can't get underwritten, you can't get approved for the long-term care. So long-term care is not available to a lot of people, so they have to find other resources.
And what do you think about the line of credit and the reverse mortgage?
Again, it's a tax-free source of income. It can be an excellent, excellent source. And that's all I can say.
Okay. Well, tax-free is important.
Oh, yeah.
Because one of the things we were talking about earlier was the fact that one of the strategies is to convert regular IRAs into Roth IRAs.
Correct.
But if you want to pull out, let's say, $200,000 from your regular IRAs and put them into a Roth IRA, you've got to pay taxes.
Why is that a good strategy, Bob?
Because the Roth IRA is tax-free when you go to disperse it. But if you take out $200,000 from your regular IRA and put it in a Roth, you've got to pay about $50,000 worth of taxes. So when you pull out 200, you really only have 150 that you're using.
And having a Roth is another good strategy because it gives you another tax-free source of money.
Tax-free, that's exactly right.
That's why it's good.
And so if somebody had a line of credit from their reverse mortgage,
Correct.
Would that be a better strategy to pay the taxes from that than from paying it out of their IRA?
Always.
That's a pretty straightforward, emphatic statement.
Yeah, because they lose the compounding value on that money.
Okay, so that's another good reason to have that line of credit.
Correct.
Okay, and just as a matter going back to the health care, I want to just give an illustration and ask what you think about it. If somebody at 62 has no mortgage on their home, they're fortunate enough to be there, and they have a value of their home that allows them to have a $200,000 line of credit which in today's world, they might need a house of about 450 to 550, somewhere in that range, which is pretty common. And they just let it sit and compound. We use about a 4 to 5% growth factor. So in 20 years, that $200,000 is going to grow to 400 and 500, and at the end of 20 years, maybe cross 500 into 600,000. And what would it be like for somebody in their middle to late 80s all of a sudden have access to $500,000 to $600,000? What kind of impact would that have?
It might keep them from having to go on Medicaid, having the government support them.
Yeah.
I mean, that could be huge.
It's a lifesaver.
It could be a lifesaver.
And you can convert that to monthly income. You don't have to have monthly income right away. So a strategy is that you let your line of credit grow and compound, and then maybe in your later years, you convert it to monthly income because it provides another need for in-home health care, for long-term care. It's whatever you need it for.
Well, the risk is huge. 70% of people will need some kind of long-term care in their life. So it's a huge risk.
Yeah. And so just to kind of wrap this up, we've had a great discussion on all of these things. I think a lot of this boils down to quality of life in retirement.
Right.
Because we run into folks all the time that have very meager subsistence kinds of living when they don't necessarily have to. Would you comment on that?
Well, big thing I think about, because I'm there. I'm going through all these things myself. Everything we talk about, I'm addressing. I'm having to deal with, okay? One of the things I always think a lot about, my wife and I talk a lot about, is we don't want our kids to have to take care of us when things get rough at the end of our life. So I think a big issue for every senior, every person going into this is independence. They want to maintain their independence. And you ask almost everybody and they'll say, I want to live in my house. I don't want to be in a retirement home. I don't want to be in assisted living. I don't want to deal with any of that kind of stuff. But they can't do it without the financial resources. So tapping in their home can be the most important thing they ever do.
Okay. You've got a lot of folks out there potentially listening and watching what we're saying. I want you to look in the camera and just address them and address their fears and hesitation about the use of a reverse mortgage. Would you do that?
Well, don't be afraid of using your home, using the equity in your home. It could be the most important decision you ever make for the rest of your life. And if you don't want to have somebody else providing all the resources to take care of you, and I don't think most of you want your kids to have to do that. You want to stay independent, and you've always lived your life in such a way that you've taken care of yourself. So if you want to take care of yourself, tap into that home equity.
Thanks. Well, thanks for listening. We're going to wrap it up here. This is Bob Muni, Senior Loan Officer with Silverleaf Mortgage, with Larry Heinrich, a good friend and financial advisor. And that's the end of another version of Silverleaf Shorts. Thanks for joining.
If you found this information interesting and helpful and you're a Colorado homeowner, we'd love to hear from you. Subscribe to our channel for more information, like us on YouTube, and give us a call. We'd love to be able to serve you.